policies, I can tell you that you can never discount any surprises from the Reserve Bank. Good morning, Ritu.
Good morning, Lata. You're right. We can never second guess the Reserve Bank of India. And like you said, because the budget will only be presented in July, perhaps the RBI will be in a bit of a wait and watch mode. The poll that we did at CNBC TV 18, as expected, throws up a status quo policy, no change on rates and no change in stance. But again, we're going to ask our guests if there could be any surprises on the macro forecast as far as the CPI is concerned. For instance, 4.5% for the fiscal, unlikely to be tinkered with. On the growth front, the current forecast is 7% for FY25. Again, 40% did say it will be left untinkered, although some were expecting an upward revision, although perhaps their answers would have changed if we asked them now versus when we did last week. Apart from that, largely the focus is going to be on two things: what the Reserve Bank of India says on liquidity, especially with, that excess cash balances sitting with the government, and then of course inflation as well, with the last mile of disinflation proving a bit trickier than expected. And of course, while the Reserve Bank of India continues to reiterate that it acts on domestic cues, US Fed, before that acts, it doesn't really seem like it's itching to cut rates in a hurry. Will the Reserve Bank of India move before that? The timing of that is something that the markets want to know. Our poll says that no change in stance until August or later, and no rate cuts at least until October.
Okay, thanks for that, Ritu. Let's get to our guests. We are being joined by Kaushik Das, the Chief Economist at Deutsche Bank, Parul Mittal Sinha, the Head of Treasury at Stanchart India. We are also joined by Lakshmi Iyer, the bond market expert from Kotak AMC, and in a bit Indrail Pal, the Chief Economist from Yes Bank. Ladies and gentlemen, it's an even house. Thank you very much for joining me. Let me start with you, Kaushik. Well, I think on rates and stance, people aren't saying much. But do you think they'll tinker with any of the forecasts?
Lata, good morning. I think, this is supposed to be a very boring policy, and, rates and stance are likely to remain unchanged. Even the forecast that you're talking about, GDP growth, I don't think RBI changes that 7% forecast. But there could be some tinkering in the quarterly forecast. RBI was mentioning their nowcasting is showing 7.5% growth for April-June of this quarter. So they may raise the April-June quarter forecast and then reduce it somewhere during the course of the year to keep 7% intact is what my expectation would be. On inflation, it's too early to make any changes. The numbers are looking good as of now. The May inflation number is again supposed to come below 5%, around the same number, 483, that we got in April. So I don't think RBI needs to change anything on inflation and growth. As far as surprises are concerned, as you mentioned, if there is a change in stance, because we know ECB has cut yesterday, Bank of Canada has cut. So if RBI says that we are forward-looking and we're just keeping that optionality with us for changing the stance, which would have them the optionality of either pausing or cutting or hiking, that could be a surprise for the market. And I don't think at this stage they will talk anything about almost sales or anything because government is sitting on cash balances. They have to actually spend the money for the liquidity to come inside the system. So it's too early. But these are the two surprises that could come, either the change of stance or anything related to liquidity or almost sale. But I'm not expecting any of these in today's announcement.
Okay. We were once expecting a huge dollar inflow because of bond and perhaps equity performance because of a stable government. Now that's got, we have seen huge equity outflows actually, dollar outflows over the past 2 days. So maybe the liquidity problem will also be a wait and watch problem. But Lakshmi, Kaushik set it up nicely. There are two central banks that have already cut globally, even if one is a hawkish cut. As well, you look at the inflation forecasts. First quarter 4.9, then 3.8, then 4.6, then 4.5. For the first time, we have an inflation forecast series, all of which is with a handle 4. So you think overall, can there be a slightly dovish tilt at all?
Hi Lata, morning. So yes, the chances of having a slightly dovish tilt in the narrative, maybe more in the talk and obviously lesser in the walk, could be possible. And I would say the key trigger for that, apart from the rate cuts that we saw, both, Canada and the ECB, not necessarily it is going to be a prolonged or a continued rate cut, but also the fact that, there has been a bazooka of money that they've received from the RBI. And given the fact that, while I'm cognizant of the fact that industrial metals are up 20% in the last 3 months, crude oil prices are down 15%. Though inflation is still, the war still continues. So I think all of that can lead to a little bit mellowing in terms of tonality. I think that's the least one can do in this kind of a scenario. But yeah, it's just too premature. And outer chances, we've seen that in politics, we can't rule that out in policy as well. Very outer chance that there could be probably some tweak in terms of the stance.
Well, yes, the RBI certainly will want to hear what happens in the July budget. But Parul, I know your base case scenario is no change in stance, rates, inflation or GDP forecasts. But is there any surprise you're expected going into the policy today? What will you watch out for?
So we'll watch out for a couple of things. One, their language on growth. So growth has been surprising on the upside, especially versus most of the forecasts in the market, and even higher than what RBI has been forecasting. Last year's GDP at 8.2%. Next year's forecast, we don't expect them to change. But how strongly confident is RBI of next year's growth at 7 or above? That's what I'll watch out for. The other is the voting pattern. So if we go through Dr. Ashima Goyal's commentary in the minutes, she was really dovish. Although she voted for no change in stance or the rates, the commentary was hugely dovish. What it tells me is that RBI, they have the room to cut, they have the room to become neutral from the inflation, especially from the inflation standpoint and the trajectory as it's unfolding, monsoons, how they're expected to unfold, but they're just keeping their options open. So, like my other co-panelists said, any change in language tilting slightly towards dovish, that is expected. The stance change we are not expecting today, just because globally there are a lot of uncertainties, and even locally now with the election results. But anytime if they give a surprise, they have the room to, and the market will react accordingly.
All right, and Mr. Indranil Pan, what is your expectation? Do you think RBI is going to make use of this opportunity, or like the rest of the panelists were saying, perhaps a wait and watch mode until they hear more from the government?
Well, I think the slight difference between the other panel and me is I definitely don't expect any change in the stance also, leave aside any rate cut. I think if I were to take a leaf out of the last minutes, they would continue to watch the monsoon scenario, and especially in the heat wave conditions, we are still to assess the type of sort of crop damage that could have happened. For us, the next inflation reading is trending closer to the 5% rather than the 4.8% number, and that is also because some amount of upside that we have seen in terms of the vegetable prices. So there continues to be huge amount of uncertainty, but the one of your panelists did mention that the commodity prices continue to be sticky, but if I look at the Brent crude from 76, 77 levels is back to around 80, so there's a lot of uncertainty there in terms of the OPEC plus stance in the future months of the year. So that's something that needs to be tracked. And RBI's own analysis does say that the survey of service sector providers, they are expecting some amount of pass through of the higher input cost to the end users, though the manufacturing sector said that they are not likely to pass it through. So my focus will actually come back on the core inflation part, given that the growth remains quite solid and strong, which provides the room for manufacturers as well as service providers to pass on the higher input costs to the end users. So the trajectory in terms of the core inflation, which has been on the softer side, and that is also to a certain extent due to the base effect of the last year, is also going to be around. And by end of the year, we will possibly be closer to a 4.2, 4.3% even in terms of the core, and that sort of provides for a situation where the assessment in terms of the incoming data becomes even more important, and also around the monsoon and the spread and timeliness of the monsoon.
No, we have to remember that at the moment it's a 200 basis point gap between the inflation for FY25 average forecast and the repo rate, which can be considered tight. I mean, of course, Jayant Verma has argued that, and that's why this expectation of dovishness at some point. But Lakshmi, we did see 6.94 on the 10-year yield for a day at least after the exit poll, and then we saw 7.03 and 0.02. It's even after a reasonable assurance of a stable government, the yields have not come back as much as the stocks came back. Do you think the RBI can do anything to bring yields down, or is this entirely a prisoner to the budget?
Lata, see the amount of dividend transfer, the detailing of that is what the markets are keen to see. How much of this will go towards a fiscal deficit reduction? How much of this actually gets routed towards incremental capex? I think some of those devil in the details is what the market is clearly looking out for. We have seen some softening in the US yields, and of course there are key data impending even today. So I think all of that is clearly playing on the sentiment, and not just the budget or not just the political outcome. Yes, budget will play a very critical role in shaping up these expectations, and not to forget that the FPI flows. I think that also is getting tracked. Though the month of May also saw net sales positive, the number was a tad lower compared to the past few months. So I think these are the current things which are playing on the market moods and sentiments right now. But doesn't look like anyone is really letting go of positions in the bond markets for now.
Okay, very quickly, I think we'll have about 90 seconds. Parul, you want to dwell on that? Anything that he can say that can bring yields down?
So any positive comments on liquidity, or even on the stance or some direction that tells the market that RBI is softening, either on the growth expectations, that will directly have impact on both the interest rate swap levels and on the bond yield levels. To just give you some sense of what market is pricing in, we are pricing in a rate cut of 25 basis points only, and that too as far out as in the month of February or April of next year. Any hint of RBI becoming confident of inflation remaining under control or growth slowing down will just make the market move that pricing forward, which can come to October, December, and also increase the rate cuts from just 25 to 50 basis points. That will be enough to move the markets by 10 to 15 basis points easily. So all in hands of RBI, but like things stand, people are just delaying all expectations because they've been disappointed before, and therefore nobody wants to come out and say that they expect rates to move lower.
Okay, yes, we are in the shadows of such a big political surprise that perhaps no one wants to take any chance and say things will be status quo or business as usual. Business is anything but as usual at this point in time. I think we are counting seconds to the governor taking the mic, and of course all these will be eagerly watched, whether there will be even a slight tremor to the withdrawal of accommodation. At the moment the stance is withdrawal of accommodation until inflation comes towards the 4% mark, gets aligned to the 4% mark. So does that word, that phrase make its appearance again will be very important, and of course any tinkering to the growth and the inflation forecast. On liquidity, actually the Reserve Bank has an easier job, but the governor is there to say that for himself.
Financial year, and this is how it goes. In the recent years, the world has gone through one crisis after another, and the pattern continues. Even against this backdrop, the Indian economy exhibits strong fundamentals together with financial stability and positive growth momentum. Nevertheless, we need to remain vigilant in an unsettled global environment. The new realities brought about by technological advancements, supply chain realignments, trade and financial fragmentation, and climate change pose opportunities as well as challenges. In this milieu, India looks ready to embark upon a new era of transformation aided by a favorable demography, improving productivity and technology, and a conducive policy environment. The confluence of these factors brightens the prospects of sustained high growth in India in the years ahead. As the Reserve Bank approaches its centenary year, that is RBI at 100, it will gear up even more to remain future ready for India's fast growing economy. It will take steps to enhance India's global footprint. For our journey during the next decade, we have drawn up strategies consisting of policy actions towards positioning the Reserve Bank as a model central bank of the global south. The agenda for the run-up to RBI at 100 is documented in the annex to this statement. I urge all keen observers of the Indian economy and the financial system to take a close look at these action plans. This is not a static document. It cannot be a static document, as we are living in a dynamic world. Our endeavor will be to continually update it as may be required from time to time. I would now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25% and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. The inflation growth balance is moving favorably. Growth is holding firm. Inflation continues to moderate, mainly driven by the core component, which reached its lowest level in the current series in April 2024. The deflation in fuel prices is ongoing. Food inflation, however, remains elevated. While the MPC took note of the disinflation achieved so far without hurting growth, it remains vigilant to any upside risks to inflation, particularly from food inflation, which could possibly derail the path of disinflation. Hence, monetary policy must continue to remain disinflationary and be resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Sustained price stability would set strong foundations for a period of high growth. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The MPC also decided to remain focused on withdrawal of accommodation to ensure anchoring of inflation expectations and fuller policy transmission. I would now like to provide an assessment of the growth and inflation conditions. Let me first briefly touch upon global growth. Global growth is sustaining its momentum in 2024 and is likely to remain resilient, supported by rebound in global trade. Inflation is easing, but the final leg of this disinflation journey may be tough. Central banks remain steadfast and data dependent in their fight against inflation. Market expectations regarding timing and pace of interest rate cuts are also changing with incoming data and central bank communication. US dollar and sovereign bond yields remain range bound. While gold prices have surged on safe haven demand, equity markets have gained in both advanced and emerging market economies since the last MPC meeting in April. Let me focus now on the domestic growth conditions. The provisional estimates released by the National Statistical Office, NSO, placed India's real gross domestic product, that is GDP growth, at 8.2% for the year 23-24. During 24-25, that is during the current year so far, domestic economic activity has maintained resilience. Manufacturing activity continues to gain ground on the back of strengthening domestic demand. The 8 core industries posted healthy growth in April 2024. Purchasing Managers Index, that is PMI in manufacturing, continued to exhibit strength in May 2024, and it is indeed the highest globally. Services sector maintained buoyancy as evident from available high-frequency indicators. PMI services stood strong at 60.2 in May 2024, indicating continued and robust expansion in activity. Private consumption, the mainstay of aggregate demand, is recovering and it is recovering with steady discretionary spending in urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. Investment activity continues to gain traction on the back of ongoing expansion in non-food bank credit. Merchandise exports expanded in April with improved global demand. Non-oil, non-gold imports entered positive territory. Services exports and imports rebounded and posted a strong growth in April this year. Looking ahead, the forecast of above normal southwest monsoon by the Indian Meteorological Department, that is IMD, is expected to boost Kharif production and replenish the reservoir levels. Strengthening agricultural sector activity is expected to boost rural consumption. On the other hand, sustained buoyancy in services activity should continue to support urban consumption. The healthy balance sheets of banks and corporates, government's continued thrust on capex, high capacity utilization and business optimism augur well for investment activity. External demand should get a fillip from improving prospects of global trade. Taking all these factors into consideration, real GDP growth for the current financial year 2024-25 is projected at 7.2%. Let me repeat, the GDP growth that we are now projecting for the current financial year 2024-25 is 7.2%, with Q1 at 7.3%, Q2 at 7.2%, Q3 at 7.3% and Q4 at 7.2%. The risks are evenly balanced. I would now like to focus on inflation. CPI headline inflation softened further during the months of March and April, though persisting food inflation pressures offset the gains of disinflation in core and deflation in fuel groups. Despite some moderation, pulses and vegetables inflation remained firmly in double digits. Vegetable prices are experiencing a summer uptick following a shallow winter season correction. The deflationary trend in fuel was driven primarily by the LPG price cuts in early March. Core inflation softened for the 11th consecutive month since June 2023. Services inflation moderated to a historic low and goods inflation remained contained. The exceptionally hot summer season and the low reservoir levels may put stress on the summer crop of vegetables and fruits. The Rabi arrivals of pulses and vegetables need to be carefully monitored. Global food prices have also started inching up. Prices of industrial metals have registered double-digit growth in the current calendar year so far. These trends, if sustained, could accentuate the recent uptick in input cost conditions for farms. On the other hand, the forecast of above normal monsoon bodes well for the Kharif season. Wheat procurement has surpassed last year's level. In fact, the buffer stocks of wheat and rice are well above the norms. These developments could bring respite to food inflation pressures, particularly in cereals and pulses. The outlook on crude oil prices remains uncertain due to geopolitical tensions. Assuming a normal monsoon, CPI inflation for 2024-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. So thus, as you can see, the GDP growth projection, we have increased it from 7%, which we gave out in the last MPC meeting. We have increased it to 7.2%, and the inflation projection, the average for the year, we have retained it at 4% as 4.5% as it was in the last MPC meeting. And I have explained there are good reasons why we have increased the GDP forecast, the GDP projection for the current year. Now, what do these inflation and growth conditions mean for monetary policy? That is the question, and I would like to answer that. The developments relating to growth and inflation are unfolding as per our expectations. When the projected GDP growth of 7.2% for 2024-25 materializes, it will be the fourth consecutive year of growth at or above 7%. Headline CPI continues to be on a disinflationary trajectory. Monetary policy has played an important role in this process. This is evident from the decline in headline inflation by 2.3 percentage points between the first quarter of 22-23 and the fourth quarter of 23-24. Supply side developments and government measures have also contributed to this moderation of headline inflation. Repeated food price shocks, however, slowed down the overall disinflation process. According to our projections, the second quarter of 2024-25 is likely to see some correction in headline inflation, but this is likely to be one-off on account of favorable base effects and may reverse in the third quarter. If you look at the projections we have given, then it becomes very clear that in the second quarter, the headline inflation is likely to come down to about 3.8%, and thereafter again it goes up. And we have given the numbers in the statement, and I have already read it out earlier. At the current juncture, therefore, the uncertainties related to food price outlook warrant close monitoring, especially their spillover risks to headline inflation. In parallel, the behavior of the core component also needs to be watched carefully. We need a descent of inflation to 4% target on a durable basis while supporting growth. Now, there is a view that in matters of monetary policy, the Reserve Bank is guided by the principle of follow the Fed. I would like to unambiguously state that while we do keep a watch on whether clouds are building up or clearing out in the distant horizon, we play the game according to the local weather and pitch conditions. In other words, while we do consider the impact of monetary policy in advanced economies on Indian markets, our actions are primarily dependent and primarily determined by the domestic growth inflation conditions and the outlook. I have said this several times earlier, but it becomes necessary to restate the position and reiterate this so that there is clarity in the mind of market participants and other stakeholders, and as a result of which they do not board the wrong bus. Liquidity and financial conditions, that is the next part which I would like to highlight. During the current financial year so far, system liquidity transited from surplus to deficit conditions and then again back to surplus in early June. In consonance with the commitment made in the April policy statement of remaining nimble and flexible in liquidity management, and in view of the shifting liquidity dynamics, the Reserve Bank mopped up surplus liquidity through variable rate reverse repo auctions, that is VRRR auctions, during the first half of April, while injecting liquidity through variable rate repo operations, that is VRR operations, in the latter part of April and in May. In the first week of June, however, VRRR auctions have been conducted. Banks' recourse to the marginal standing facility, that is MSF, under the liquidity adjustment facility remained low during 2024-25, that is in the current year so far. Now, mirroring the liquidity dynamics which I just explained, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Now, I have explained, for common listeners and for others, I have explained what exactly the corridor means in the footnote. And let me also state here that most of the statements which I am making are backed by data, and the data is given in the footnotes, and I would encourage you to have a look at footnotes to understand why we are making certain statements. So mirroring the liquidity dynamics, as I said, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Across the term money market segment, the yields on certificates of deposit, that is CDs, commercial papers, that is CP, issued by non-banking financial companies, that is NBFCs, and 3-month treasury bills, that is T-bills, also eased. In the credit market, monetary transmission remains ongoing. As you would be aware, the Central Board of the Reserve Bank decided to transfer rupees 2.11 lakh crore as surplus to the central government for the accounting year 2023-24. As the economy remains robust and resilient, the Central Board decided to utilize this opportunity to increase the risk provisioning under the contingent reserve buffer to 6.5% of the Reserve Bank's balance sheet for 2023-24 from 6% in 2022-23. In other words, the contingent reserve buffer, which was 6% in 22-23, was enhanced by the Central Board to 6.5% in the current for the year 22-23. Now, this risk provisioning, that is this provision for contingent reserve buffer, or CRB as we call it, this would further strengthen the Reserve Bank's balance sheet. Prudence is at the core of our standard operating procedure. The Indian rupee moved in a narrow range with a low volatility during 2024-25 so far, that is up to June 5th, and that's the figure I have given. Now, this has happened despite the rupee trading under pressure amidst foreign portfolio, that is FPI outflows. The relative stability of the Indian rupee bears testimony to India's sound and resilient economic fundamentals and its macroeconomic and financial stability and improvement in the external outlook. Looking ahead, the Reserve Bank will, and I'm providing some kind of a forward guidance here with regard to liquidity and our approach to the markets. Looking ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. I would like to read this sentence once again for clarity. And it's not just for clarity but to reiterate the position. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. and this is consistent with our approach which we have been adopting. Even during COVID times we adopted the same approach, and thereafter we have continued. So therefore our focus is to ensure stability and orderliness in all segments of financial markets and institutions which are regulated by the Reserve Bank. I would now turn to financial stability. The annual financial results of 2023-24 indicate that the banking system remained sound and resilient, backed by improvement in asset quality, enhanced provisioning for bad loans, sustained capital adequacy, and rise in profitability. The non-banking financial companies, that is NBFCs, also displayed strong financials in line with the banking sector. Notably, the gross non-performing assets, that is the GNPAs of scheduled commercial banks and NBFCs, are below 3% of total advances at the end of March 2024. It is important that regulated entities should continue to improve their governance standards, risk management practices, and compliance culture across the organization. In November last year, we had flagged certain concerns on excessive growth in unsecured retail loans and over-reliance of NBFCs on bank funding. Recent data suggests that there is some moderation in these loans and advances. We are closely monitoring the incoming data to ascertain if further measures are necessary. The boards and top management of regulated entities should ensure that risk limits and exposures for each line of business are kept well within their respective risk appetite framework. The persisting gap between credit and deposit growth rates warrants a rethink by the boards of banks to re-strategize their business plans. A prudent balance between asset and liabilities has to be maintained. Customer protection remains on top of the Reserve Bank's priorities. In general, we have observed that the guidelines on key fact statement, in fact I have explained key fact statement also in the footnote, the customer protection, as I am just repeating, customer protection remains on top of Reserve Bank's priorities. In fact, it would be of interest to you that in this year's annual report, we have a separate box item which lists out the customer-centric measures that the Reserve Bank has taken. And in the same vein, we have also a box item in the annual report which has just been released recently. There is a box item on the number of regulatory measures which were taken after carrying out stakeholder consultations. And these two box items, I would encourage those who are interested to please have a look at them. So in general, we have observed that the guidelines on key fact statement are followed, but a few regulated entities still charge fees, etc., that are not specified or disclosed in the key fact statement, that is KFS. It has also been observed that in some microfinance institutions and NBFCs that the interest rates on small value loans are high and appear to be usurious. The regulatory freedom enjoyed by the regulated entities in respect of interest rates and charges should be used judiciously to ensure fair and transparent pricing of products and services. The Reserve Bank continues its constructive engagement with such financial entities to safeguard the interest of customers and ensure overall financial stability. Now let me make it very clear that we are observing all these trends, and our focus is always to interact, to engage with the sectoral players, to engage with the individual banks or NBFCs or the MFIs and encourage them to take necessary corrective measures, because it's for the regulator and the regulated entities together. We have to work to ensure that your health, that is the health of the banks and NBFCs and the microfinance institutions, remain robust, the health remains good, and if that happens and when that happens, it's good for the economy. I'm not saying that there is any big amount of problem at the moment. Overall, as I have said, let me again re-emphasize, the banking sector, the NBFC sector, the MFI sector, overall financial sector remains healthy and stable. But there are a few outliers and I was mainly focusing on them. Let me now turn to the external sector. With lower trade deficit, robust services export growth and strong remittances, the current account deficit is expected to have moderated in Q4 2023-24. Services exports were predominantly driven by software exports. Other business services and travel services exports were predominantly driven by software exports, other business services and travel exports. The phenomenal rise in global capability centers, that is GCCs, in India has provided a significant boost to India's software and business services exports. India, with an expected 15.2% share in world remittances in 2024, continues to be the largest recipient of remittances globally. Overall, the current account deficit for the current year, that is 2024-25, is expected to remain well within its sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, surged in 23-24 with net FPI inflows of around US $41.6 billion. Since the beginning of 2024-25, however, foreign portfolio investors have turned net sellers in the domestic market with net outflows of US $5 billion till June 5. In 2023, India retained its position as the most attractive destination for greenfield foreign direct investment, that is greenfield FDI in Asia and Pacific. Gross FDI remained robust in 23-24, but net FDI moderated. External commercial borrowings, that is ECBs, and non-resident deposits recorded high net inflows as compared with the previous year. The amount of ECB agreements also grew markedly during the year. Now I have given the relevant data in the footnotes. Now touching a new milestone, India's foreign exchange reserves reached a historical high of US $651.5 billion as on 31st May. India's external sector remains resilient and the key external vulnerability indicators continue to improve. Overall, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures, and there are, I think, about there are few of them, and at the end, in the concluding para, I would like to also provide some guidance for the way forward. The first announcement relates to review of limit for bulk deposits in banks. On a review of bulk deposit limit, it is proposed to revise the definition of bulk deposits as single rupee term deposit of 3 crore, rupees 3 crore and above for scheduled commercial banks, excluding the regional rural banks, and this also is applicable, that is from this definition of single rupee term deposit of 3 crore is applicable to both scheduled commercial banks and SFBs and not RRBs. Further, it is also proposed to define the bulk deposit limit for local area banks as single rupee term deposit of rupees 1 crore and above as applicable in the case of RRBs. The next announcement relates to rationalization of guidelines for export and import of goods and services under the Foreign Exchange Management Act, that is FEMA 1999. In view of the changing dynamics of international trade and in line with the progressive liberalization of foreign exchange regulations, it is proposed to rationalize the extant FEMA guidelines on export and import of goods and services. This will further promote ease of doing business and provide greater operational flexibility to authorized dealer banks. Draft guidelines will be issued shortly for stakeholder feedback. The next announcement relates to setting up of a digital payments intelligence platform. The Reserve Bank has taken a number of measures over the years to deepen digital payments while ensuring their safety and security. These measures have boosted consumer confidence. Growing instances of digital frauds, however, highlight the need for a system-wide approach to prevent and mitigate such frauds. It is therefore proposed to establish a digital payments intelligence platform for network-level intelligence and real-time data sharing across the digital payments ecosystem. To take this initiative forward, the Reserve Bank has constituted a committee to examine various aspects of setting up this platform. The next announcement relates to inclusion of recurring payments with auto-replenishment facility under the e-mandate framework. The adoption of e-mandates for recurring payment transactions has been increasing. It is now proposed to include payments such as replenishment of balances in FASTag, National Common Mobility Card, that is NCMC, etc., which are recurring in nature but without any fixed periodicity in the e-mandate framework. This will enable customers to automatically replenish the balances in FASTag, NCMC, etc. if the balance goes below the threshold limit set by them. This will enhance convenience in making travel and mobility related payments. The next announcement relates to introduction of auto replenishment of UPI Lite wallet, and it also includes inclusion under the e-mandate framework. UPI Lite was introduced in September 2022 to enable small value payments in a quick and seamless manner through an on-device wallet. To encourage wider adoption of UPI Lite, it is now proposed to bring it under the e-mandate framework by introducing a facility for customers to automatically replenish their UPI Lite wallets if the balance goes below the threshold limit set by them. There could be some, I think if you want better clarity, this statement will be uploaded immediately after my, my address, my statement is over in the next couple of minutes. So please have a look at the uploaded version, that will give you clarity. We try to avoid long sentences, but sometimes it becomes difficult and unavoidable. So please bear with me. Now this measure will further enhance the ease of making small value digital payments. And the final announcement relates to Harbinger 2024, Innovation for Transformation. The Reserve Bank has taken several pioneering initiatives in recent years to encourage innovation in the fintech sector. One such key initiative is the global hackathon, that is Harbinger Innovation for Transformation. The first two editions of the hackathon were completed in the year 2022 and 2023. The third edition of the global hackathon, Harbinger 2024, with two themes, namely Zero Financial Frauds and being Divyang Friendly, will be launched shortly. Let me now conclude. At the Reserve Bank, our job demands poise, patience and perseverance. India's recent economic progress, continued momentum in economic activity and the overall promising economic prospects validate our approach to policy making. At the moment, the Indian economy is at an inflection point in its path towards greater transformational changes that will bring about more stability and growth. On inflation, we are on the right track, but there is still work to be done. Globally, there are concerns that the last mile of disinflation might be protracted and arduous amidst continuing geopolitical conflicts, supply chain disruptions and commodity price volatility. In India, with growth holding firm, monetary policy has greater elbow room to pursue price stability to ensure that inflation aligns to the target on a durable basis. In its current setting, monetary policy remains squarely focused on price stability to effectively anchor inflation expectations and provide the required foundation for sustained growth over a period of time. The words of Mahatma Gandhi resonate here, and I quote, "If we are sure of our path," I repeat, "if we are sure of our path, we should go on striving for it incessantly and uninterruptedly." Thank you. Namaskar.
Okay. If you thought that there are no surprises, well, the governor has disappointed us. In fact, has surprised us with a very big one. Growth upped to 7.2%. There was an expectation that, after that blockbuster Q4 number, there is a chance, but after the political uncertainty, those hopes got watered down. But the governor has come with a 7.2% growth upgrade from an already high 7%. I think there are two people, at least SBI and Citi, which are in the 7% plus category. But this will be a surprise to the rest of the economists. And CPI, I think it's important to note the vote. While it is the interest rate and the stance has been maintained as in the previous policy, the interest rate support has come only from 4 out of the 6 members and not 5 as was previously the case for the stance. In fact, for the rate, I think it was a full house that supported last time. This time there are 2 people asking for a rate cut. So that puts the, expectation of a rate cut a little more in people's view. But to be fair, the governor was absolutely clear in his tone that the Reserve Bank is cognizant of, inflation, the last mile inflation coming down being difficult all over the world. And therefore it doesn't look like it's very imminent, but clearly the fact that 2 people are asking for both a change of stance and a change in rates or a lowering of rates is very important. It can't be bypassed. So growth higher and inflation likely a small, foothold that things could get dovish in the year makes for an excellent policy for at least the stock markets. I was just noticing the bond market, not much of a move. I mean, it was 7.019 before we went into the policy. It is 7.018 after the policy, so not much of a change over there. Let me get our experts to comment. We've got Kaushik Das, Upasana Bharadwaj, we've got SBI Managing Director Mr. Sethi, Shobit Mehrotra from HDFC Asset Management, Rajiv Anand from Axis Bank, and in a bit even Mr. Ashwini Kumar of UCO Bank will be joining us. Well, first to the economists. Upasana, 7.2, will you be pushed to upgrade your own forecast?
Lata, we are surprised with that upward revision. We were expecting them to retain it. We are actually expecting 6.9%. So we were already lower than what RBI was earlier estimating. So this upgrade, of course, probably they've taken cognizant of the overall previous revisions and done some changes. But we believe that somewhere the global slowdown in the second half of the year will start pinching, and we will see some slowdown then. So I think it's a little optimistic, but we'll see how things fare. At least for the month of April and early indicators of May, growth has held up well. So the first quarter may still tick off as per RBI's expectations, but beyond that, I will have to remain a little watchful. But otherwise, I would say that besides the GDP upgrade, overall the policy is fairly in line with what probably we were expecting or the markets were also expecting. It's a fairly balanced tone that RBI governor has maintained. And, the emphasis and the complete focus still remains on ensuring that the 4% last mile disinflation will have to be attained, and they have to get the confidence before they can really act. I think that is one big key takeaway. But besides that, I think it's a very balanced tone, and that's very positive otherwise.
Yep. I actually, even if the bond markets have not moved, if anything, very marginally, the stock markets have clearly given a big thumbs up. At the moment, almost racing to 1% gain. So the upgrade in growth is perhaps, stock markets normally look at central banks as the conservative element. And if the conservative element is talking about a 7.2% growth, then the market has something to cheer, at least at this point in time. Kaushik, key takeaways?
The upgrading growth is a good development, but we have to think whether that upgrade will come with some bit of monetary easing or it will come on its own. I would guess that in order to get a 7% plus growth in FY25 on the back of 8.2 last year, and the fact that fiscal consolidation will continue, you can't maintain this kind of momentum unless you give some monetary policy easing. And today we have made one step closer to that by two members calling for a rate cut. So we are making all these baby steps towards a monetary easing cycle. Probably by the time we come to the October-December quarter, we could end up getting some rate cuts, because remember, monetary policy is always forward-looking and it takes time for transmission to take place over a next few quarters. So I guess 7.2%, you were mentioning that inflation number all were below 5%. It's still been maintained at 4% handle for all the quarters. But now if you see the growth numbers, everything is up to 7% handle. So it's kind of a balanced kind of number between growth and inflation. The other thing which Governor spoke a lot about and which is important too is the financial stability angle, that whether you look at the banking system or you look at the financial system or the external sector, everything looks pretty strong. And going forward also RBI will make sure that the macro financial stability remains strong. So I would guess like by the time we October, December, by that time the Fed has already moved, we could end into a rating cycle starting from that quarter.
Okay. Well, once again, I'm lured by the markets. The governor's of 7.2% has certainly taken the stock markets, the stock indexes, the Nifty index above the 23,000 mark. We have been there, done that, but after that big reseeding of the markets, this will definitely come as a bullish shot in the arm for the markets. Shobit Mehrotra of HDFC AMC is with us. Any thoughts, takeaways for the bond market?
Lata,
Shobit?
I think, Lata, I think the big takeaway for the market is going to be that the fiscal position, which is already pretty strong in a high growth environment, in a positive growth environment. I think the fiscal position would continue to be the hallmark for the bond market. I think 5.1, even if it is not improved in the full year budget, even if we have just at 5.1, I think achieving or bettering that by the March 25 is still a distinct possibility, which means collections will be solid, robust. GST collections, direct taxes, indirect taxes, both can contribute to improving the fiscal position. And for bond market, I think with JP Morgan bond index inclusion, flows and fiscal remaining positive, I think bond market yields will held low.
Okay. All right. So the long and the short of what you're saying is that you're more looking at budget and Delhi, that the bond market is at the moment slightly less interested in what Reserve Bank is saying. I can see that. That's what we started with. Now let me get to the big bankers. Mr. Sethi, the Managing Director of State Bank, is with us. Mr. Sethi, first your overall takeaway, but more importantly, this redefinition of bulk deposits. I thought it used to be 2 crore and above. Now they've made it 3 crore and above. How does that change a banker's life?
Lata, first I would like to say a few words on the positives. Of course, as you mentioned, the growth upgrade is definitely extremely positive, and though our house view, as you mentioned, was above 7, I think it was around 7.5 if I remember correctly. So, but 7.2 coming from the central bank is definitely a positive, and moderating inflation, though the RBI seems to be very firm that the 4% level has to be reached before the stance or any other things are revisited. On the rates and the stance, of course, is on the expected lines, as everybody mentioned, more in terms of the growth forecast being higher. And also a few things what Governor mentioned in terms of 8 core industries doing very well. In fact, that is also getting reflected in the first quarter. Credit growth usually used to be a little moderate in the corporate side, but we see a continued growth in the corporates. The other things very important things what Governor mentioned in terms of systemic liquidity, I think system liquidity is positive currently. But what we have seen is that normally system liquidity comes into positive territory during the first 1 week and 10 days, and then it gets into the deficit as the advanced tax payments and the GST payments start, moving out rather. And that is where I think the comfort what Governor furnished in terms of being nimble and flexible, both by way of VRR and VRRR, which we have seen in the last several months, that that liquidity support what RBI has been providing to the market to ensure that there is no problem of liquidity. I think the fourth piece, important piece, is in terms of the deposit and credit growth rates, gap increasing. That I think has been there for quite some time because of the very significant credit growth which was happening, and also some of the financialization of to other than deposits which has been happening in the savings. But I think RBI also seems to be a little concerned in terms of wholesale deposits. You rightly said that it used to be 2 crores the bulk deposit definition. It used to be 1 crore a few years ago, and increased to 2 crores, and now increased to 3 crores, which means they probably are sending a signal that don't depend too much on the wholesale deposit growth to fund the credit growth. Banks like SBI, of course, with a huge franchise, have ability to raise the retail deposits, but even other banks also are mindful of the margin pressures, and I'm sure everybody would be focusing on the retail deposit growth rate. So these are a few things I thought I would share with you.
Yeah, sure. Mr. Sethi, because of this redefinition of bulk deposit, do you think that credit growth could slow down a bit, because there could be some smaller banks which now have to run for retail deposits a little harder? Do you see a rise in deposit rates and therefore any impact on credit growth as well, Mr. Sethi?
I don't see direct impact on the credit growth, but I think definitely there would be higher cost which some of the banks have to pay for the bulk deposits. I think, or maybe even the readjustment in the retail deposits also is required to be done.
All right, I'm just going to take, the focus away from the macros for a bit, because there was a lot that the Reserve Bank of India governor said about regulated entities. While he acknowledged that banks and NBFCs, have a very strong, healthy balance sheet, gross NPAs have come down significantly, he repeated a warning that as far as charging of rates and fees is concerned, in the key fact statement, for instance, the Reserve Bank of India has observed that there are still some MFIs, NBFC MFIs, that are charging very high usurious rates, and the Reserve Bank of India governor almost warned them, saying, we've been engaging with these entities, and if we continue to see these kind of observations, there will be action. The second, of course, as Mr. Sethi was also highlighting, there continues to be a deposit credit mismatch. That is again something that the Reserve Bank of India governor has highlighted before, again bringing to the fore. And the third thing, of course, is RBI said that since raising the risk weights in November last year, yes, the unsecured lending book that has continued to come down, which is visible from the latest data from the Reserve Bank of India. But he also said that the Reserve Bank will closely monitor data to ascertain if further measures are needed, to monitor this unsecured, unnecessary, this large growth in unsecured lending. So those are some of the things that he said, about banks and NBFCs that we'll keep a focus on. But Mr. Rajiv Anand, just to come back to you again on these bulk deposits, the revision of the definition from 2 crores to 3 crores, what would that mean for banks like you, as Mr. Sethi was saying? Perhaps, will there be some impact on the credit front?
No, absolutely not. And good morning to all. I think the move of defining bulk deposits from 2 crores to 3 crores, I don't think is material at this stage. It's just a definitional issue. And I think, to that extent, will not impact either, growth in deposits or, credit, as both you and Lata mentioned. I think the way to think about, what is happening currently is that it looks like there are two markets. At one end, as Shobit mentioned, the long bond is rallying. We're almost at 7%. the fact that the fisc is in pretty good shape. Growth will ensure that revenues will continue to be strong into the quarter, and of course, in the JP Morgan index inclusion has meant that the long bond market is quite bullish. But on the other side, if you see liquidity, through the lens of deposit rates up to, let's say, 1 year, those continue to be at elevated levels. Banks are raising money at anything between 7.5 to 7.75, and the hope that banks have really is that as government spending increases now that the elections are behind us, currency in circulation comes back, and FX flows happen, that the short end of the curve, which is today elevated, begins to come off, and there is some semblance of ease of liquidity as we go forward. And I think that is, to my mind, the greater focus as far as banks are concerned.
All right, and from the statement on that has now been released on RBI's website, we know that the two MPC members expectedly that voted against both the rate action and the stance are Dr. Ashima Goyal and Professor Jayant Verma. Kaushik, a quick comment on this. So far, we've been seeing, of course, Professor Jayant Verma, voting for a rate cut. Dr. Ashima Goyal talking about the need for a change in stance. Now, 2 members out of 6 very clearly siding with a shift in stance, a cut for rates. What would this mean going ahead? Just your quick thoughts on this, Kaushik.
Ritu, the thing is that, as I mentioned, that they're taking one bit step closer to the easing cycle, and we've already seen some global central banks like ECB, Bank of Canada, they've started easing rates. The big one obviously is the Fed, and today non-farm payrolls data is coming out. Next week the US CPI data is coming out, so if they are like a little weaker, expectations of a September rate cut from the Fed could get stronger. And if that were to happen, then it's very possible that in October, December of this quarter, you could have RBI moving and looking to ease rates. And in order to do that, they have to make that transition slowly so that market is prepared. So one way to do it is through MPC members voting their individual whatever expectations. So you've got now, instead of 5:1, 4:2, and by the time you go to August, remember, August will be the last meeting for all these non-RBI MPC members. From October, there would be 3 set of new non-RBI MPC members. So it's very possible that in August, the numbers could increase in favor of a change of stance, or there may be an outright change of stance itself, because in July and June, inflation would come down quite significantly. RBI probably could be comfortable by that time to change the stance. And then sometime in October, December, you could start the easing cycle going into 2025. Now, always remember 2 things. One is monetary policy is forward-looking. So if you have to affect the monetary policy change into real economy, what you do in October, December might take 6 months' time to filter into the real economy. So you're not just going to look at today's number to decide what to do. You are going to look at the next 12 months number on inflation and growth, and then decide what you need to do today. So from that standpoint, I think that move has been made. And the other interesting thing Lata was asking for takeaway, one thing which RBI Governor categorically mentioned is that RBI gives more importance to domestic factors while deciding on monetary policy, and not just follow the Fed blindly. It's in a way to say, in my view, my takeaway was that RBI is trying to, kind of make them more independent of the Fed in case the Fed were not to cut at all in 2024, or they have their own problems of fiscal and inflation. Then if the India inflation story improves, then RBI could be in a position to cut rates and not wait for the Fed.
Despite the RBI governor saying that multiple times, I guess the markets have continued to say that the RBI follows the Fed. And, interesting quote there coming in from the governor saying, I want to state that while we do keep a watch on whether clouds are building at the horizon, we play the game according to our pitch conditions. So reiterating that thought again, Mr. Ashwini Kumar, you've been standing by patiently. Just a quick thought on, what you made of the governor's comments on, the growth trajectory also picking up, and what it means for banks like you, especially with the bulk deposit definition being revised.
Good morning to all. As Governor also told, that this will be the 4th year where we will be targeting 7% growth in a row. And for the banks particularly, if we talk about, I think this is a great opportunity for the credit growth is concerned. And as we have seen good credit growth in the previous years, this year again will be the credit growth opportunities for the banks will be there. So far as the bulk deposit is concerned, it is a correction. I think only that any deposit below 3 crore now will be classified as a retail term deposit, and above 3 crore will be classified as a bulk deposit. It's not going to make much of the difference as far as the raising of deposit is concerned or the raising of resources is concerned. As if I have to talk about say UCO Bank, we have been maintaining our bulk deposit in a range, and in 2020